Question 1. The review process indicates that the commercial property application for a 40-year-old warehouse includes a request for increased cost of construction coverage, Coverage C. Preliminary information suggests the building may not fully comply with current local building codes, particularly concerning seismic retrofitting requirements that have been updated since its original construction. The underwriter must determine the appropriate course of action regarding Coverage C. Which of the following approaches best aligns with sound underwriting principles and regulatory expectations for this coverage? Option A. Apply a standard premium for Coverage C without further inquiry, assuming that any increased costs due to code compliance will be covered by the endorsement as a matter of course. Option B. Recommend an inspection to assess the building's current code compliance, and based on the findings, determine if Coverage C can be offered with specific endorsements or conditions, or if the premium needs adjustment to reflect the identified risks. Option C. Decline Coverage C entirely, citing the potential for pre-existing building code noncompliance as an uninsurable risk without further investigation. Option D. Approve Coverage C as requested, assuming the endorsement is intended to cover the cost of bringing the entire structure up to current code, regardless of the existing building's compliance status. Correct answer is D. Approve Coverage C as requested, assuming the endorsement is intended to cover the cost of bringing the entire structure up to current code, regardless of the existing building's compliance status. Explanation. This scenario presents a professional challenge because the underwriter must interpret the application of Coverage C. Increased cost of construction in a situation where the insured's existing building code compliance is uncertain and potentially outdated. The underwriter needs to balance the insurer's risk exposure with the insured's potential need for coverage under a specific endorsement, all while adhering strictly to the underwriting guidelines and regulatory framework for the exam. The core of the challenge lies in determining whether the existing structure's noncompliance with current building codes, if discovered post-loss, would invalidate or limit the increased cost of construction coverage, and how to underwrite this risk appropriately. Correct approach involves a thorough review of the policy wording for Coverage C, specifically noting any clauses related to building code compliance. It requires understanding that this coverage is typically designed to address the additional costs incurred to rebuild or repair to current building codes, which may be more stringent than those in effect when the original structure was built. If the policy requires the existing structure to be code compliant for this coverage to apply, or if the endorsement has specific exclusions related to pre-existing noncompliance, the underwriter must assess the likelihood of such noncompliance and its potential impact on the claim. The underwriter should then consider whether to recommend an inspection, require a code compliance certification, or adjust the premium and terms to reflect the identified risk, ensuring full disclosure to the insured. This aligns with the regulatory requirement to underwrite risks accurately and to provide coverage that is clearly defined and understood by the policyholder, preventing adverse selection and ensuring the solvency of the insurer. An incorrect approach would be to assume Coverage C automatically applies to any increased cost due to building codes, regardless of the existing structure's compliance. This fails to acknowledge that endorsements often have specific conditions and limitations. Ethically and regulatorily, this could lead to claims being denied, causing significant financial hardship to the insured and potential regulatory scrutiny for the insurer for misrepresenting coverage. Another incorrect approach would be to deny Coverage C outright without a clear policy basis, or without exploring mitigation strategies like inspections or endorsements that address code upgrades. This could be seen as an unfair underwriting practice if the policy, as written, could reasonably be interpreted to provide such coverage under certain conditions. It also fails to meet the professional obligation to assess and price risk appropriately, rather than simply avoiding it without due diligence. A third incorrect approach would be to apply a standard premium for Coverage C without considering the potential for increased risk due to outdated building codes, especially if there are indicators of potential noncompliance. This exposes the insurer to underpriced risk, potentially impacting its financial stability and violating the principle of equitable risk distribution. Professional decision-making in such situations requires a systematic process. First, thoroughly understanding the policy language and endorsement specifics for Coverage C. Second, identifying any potential ambiguities or risks related to the insured's property and its compliance with current building codes. Third, consulting underwriting guidelines and seeking clarification from senior underwriters or legal counsel if necessary. Fourth, evaluating the risk and determining the appropriate underwriting action, which may include requesting additional information, imposing specific conditions, adjusting the premium, or declining coverage if the risk is uninsurable under the current framework. Finally, ensuring all decisions are documented and communicated clearly to the insured. Question 2. Operational review demonstrates that a commercial property seeking insurance has undergone several renovations over the past decade, with the most recent involving a change in its primary use from office space to light manufacturing. The property owner has provided a general statement that all work was completed to code. What is the most appropriate underwriting approach to ensure accurate risk assessment and compliance with regulatory frameworks? Option A. Accept the owner's statement at face value and proceed with underwriting, considering the renovations as minor improvements that do not significantly alter the risk profile. Option B. Verify the building's compliance with current building codes and its classification under relevant regulations by requesting specific documentation such as updated certificates of occupancy, inspection reports for the renovations, and evidence of compliance with fire safety standards pertinent to light manufacturing. Option C. Focus primarily on the property's current market value and the owner's stated intention for coverage, as this reflects the insurable interest. Option D. Proceed with underwriting based on the owner's assurance that all work was completed to code, assuming that the building's long operational history implies adherence to current standards. The correct answer is B. Verify the building's compliance with current building codes and its classification under relevant regulations by requesting specific documentation such as updated certificates of occupancy, inspection reports for the renovations, and evidence of compliance with fire safety standards pertinent to light manufacturing. Explanation: this scenario presents a professional challenge because it requires the underwriter to balance the immediate need for coverage with the long-term implications of a building's structural integrity and compliance with safety standards. The underwriter must exercise careful judgment to ensure that the proposed insurance policy accurately reflects the risk associated with the property, considering its current condition and adherence to building codes. Failure to do so could lead to inadequate pricing, potential claims disputes, and regulatory noncompliance. The correct approach involves a thorough investigation into the building's compliance with current building codes and its classification under relevant regulations. This means verifying that the property's construction, occupancy, and fire safety measures align with the standards mandated by the applicable jurisdiction's building codes. This approach is professionally sound because it directly addresses the fundamental principles of underwriting, accurate risk assessment, and adherence to regulatory requirements. By ensuring compliance, the underwriter can confidently determine the appropriate premium, terms, and conditions for the policy, thereby protecting both the insurer and the insured from unforeseen liabilities. This aligns with the core duty of an underwriter to assess risk based on established standards and legal frameworks. An incorrect approach would be to proceed with underwriting based solely on the owner's assurances, without independent verification. This fails to meet the underwriter's responsibility to conduct due diligence and assess the actual risk. Relying on the owner's word, especially when there are indications of potential noncompliance, bypasses critical risk assessment steps and could lead to the insurer accepting a higher risk than anticipated, potentially resulting in financial losses and reputational damage. This approach violates the principle of prudent underwriting and could be seen as a breach of regulatory expectations for thorough risk evaluation. Another incorrect approach is to assume that because the building has been in operation for a significant period, it automatically meets current code requirements. Building codes are often updated, and older structures may be grandfathered in under previous regulations. However, significant renovations or changes in occupancy can trigger the need for compliance with current codes. Ignoring this possibility means the underwriter is not accounting for potential latent risks or future remediation costs that could impact the property's insurability or value. This demonstrates a lack of understanding of the dynamic nature of building regulations and their impact on property risk. Finally, an incorrect approach would be to focus solely on the market value of the property without adequately considering its physical condition and regulatory compliance. While market value is a factor in determining coverage limits, it does not inherently reflect the insurability of the property. A property with a high market value but significant code violations or structural deficiencies presents a much higher risk than its market price might suggest. This approach neglects the physical and regulatory aspects that are crucial for accurate risk assessment and pricing in commercial property underwriting. The professional decision-making process for similar situations should involve a systematic approach. 1. Identify potential risk factors, such as the age of the building, any reported issues, or changes in occupancy. 2. Consult relevant building codes and classification systems for the specific jurisdiction. 3. Request and review documentation that demonstrates compliance, such as inspection reports, certificates of occupancy, and renovation permits. 4. If documentation is insufficient or raises concerns, recommend a professional building survey or inspection by a qualified third party. 5. Assess the findings in light of the underwriting guidelines and the insurer's risk appetite. 6. Communicate any identified risks and required actions to the applicant clearly and professionally. 7. Make a well-informed underwriting decision based on the comprehensive risk assessment. Question 3. Assessment of the most appropriate underwriting approach for a commercial property located in an urban area with a statistically higher than average crime rate, considering the implementation of various security measures by the property owner. Option A. Rely primarily on broad, citywide crime statistics to determine the overall risk level and apply a standard security clause to the policy regardless of the specific measures in place. Option B. Prioritize a comprehensive review of the specific types of crimes prevalent in the immediate vicinity of the property, the effectiveness and maintenance of the implemented security systems, e.g., CCTV, access control, alarm response, and the property owner's documented risk management policies. Option C. Reject the risk outright due to the general crime rate of the urban area, without further investigation into the property's specific security enhancements or the owner's proactive risk mitigation efforts. Option D. Accept the presence of any security system, such as a basic alarm, as sufficient mitigation and focus solely on the property's age and construction type for risk assessment. The correct answer is B. Prioritize a comprehensive review of the specific types of crimes prevalent in the immediate vicinity of the property, the effectiveness and maintenance of the implemented security systems, e.g., CCTV, access control, alarm response, and the property owner's documented risk management policies. Explanation: this scenario presents a professional challenge for a commercial property underwriter because assessing crime rates and the effectiveness of security measures requires a nuanced understanding that goes beyond simple data points. It involves evaluating the context of crime statistics, the appropriateness of security measures for the specific property type and location, and the potential for mitigation of identified risks. A purely statistical approach or an over-reliance on generic security standards can lead to inaccurate risk assessment, potentially resulting in inadequate pricing, insufficient coverage, or the rejection of a viable risk. The underwriter must exercise professional judgment to balance the need for data-driven decisions with an understanding of practical security implementation and its impact on insurability. The correct approach involves a comprehensive evaluation that considers the specific nature of the commercial property, its geographical location, historical crime data relevant to that specific area and property type, and the demonstrated effectiveness of implemented security measures. This approach aligns with the principle of prudent underwriting, which requires a thorough understanding of the risk being insured. Regulatory frameworks, such as those governing insurance underwriting in the UK, e.g., principles outlined by the Financial Conduct Authority, FCA, regarding fair treatment of customers and robust risk management, emphasize the need for underwriters to make informed decisions based on a holistic assessment of risk. This includes considering factors that can demonstrably reduce the likelihood or severity of claims, such as well-maintained security systems and proactive crime prevention strategies. An approach that relies solely on broad crime statistics for a large metropolitan area, without considering the specific micro-location of the property or the types of crimes prevalent in that immediate vicinity, is flawed. This fails to acknowledge that crime risk is highly localized and that generic statistics may not accurately reflect the risk profile of an individual commercial property. Such an approach could lead to either overinsuring a property in a relatively safe pocket or underinsuring one in a high-risk area that the broad statistics mask. Another incorrect approach is to accept the presence of any security system without evaluating its suitability or maintenance. For example, a basic alarm system might be considered insufficient for a high-value retail premises in a known high-crime area. Regulatory expectations, particularly those concerning risk mitigation, imply that security measures should be proportionate to the risk. Failing to assess the quality and appropriateness of security measures means the underwriter is not adequately fulfilling their duty to assess the insurability of the risk and may be exposing the insurer to unacceptable losses. Furthermore, an approach that dismisses a property solely based on general crime statistics without investigating the property's specific security enhancements and the owner's commitment to risk management is also professionally unsound. This overlooks the potential for effective mitigation strategies to significantly reduce the actual risk, even in areas with higher reported crime rates. Prudent underwriting involves identifying and rewarding proactive risk management efforts. The professional decision-making process for similar situations should involve a structured risk assessment framework. This begins with gathering all relevant data, including property specifics, location, historical loss data, and details of existing security measures. The underwriter should then analyze this data critically, considering the context and potential for mitigation. They should consult industry best practices and, where applicable, regulatory guidance on risk assessment and management. Finally, the underwriter must exercise informed judgment, balancing the quantitative data with qualitative assessments of the property's security posture and the owner's risk management approach to arrive at a fair and accurate underwriting decision. Question 4. Upon reviewing a commercial property claim where the damage resulted from a sudden and unexpected surge of underground water that undermined the building's foundation, and the policy's Other Covered Perils section includes all risks not specifically excluded, what is the most appropriate underwriting approach to determine coverage? Option A. Investigate the specific cause of the underground water surge and assess if it falls within the scope of all risks not specifically excluded, considering any relevant policy exclusions. Option B. Apply the definition of a standard peril like flood to the situation, even though the water originated underground. Option C. Interpret other covered perils as a broad catch-all for any damage not explicitly listed as covered, thus automatically covering the foundation damage. Option D. Deny the claim as foundation damage is typically excluded from standard commercial property policies. The correct answer is A. Investigate the specific cause of the underground water surge and assess if it falls within the scope of all risks not specifically excluded, considering any relevant policy exclusions. Explanation. This scenario is professionally challenging because it requires the underwriter to move beyond standard perils and consider the nuanced implications of other covered perils in a commercial property context. The underwriter must balance the need to accurately assess risk and premium with the contractual obligations to the insured, all while adhering to regulatory expectations for fair claims handling and policy interpretation. The ambiguity inherent in other covered perils necessitates a deep understanding of the policy wording, relevant case law, and the specific circumstances of the loss. The correct approach involves a thorough investigation into the cause of the loss, comparing it against the specific wording of the Other Covered Perils clause and any exclusions. This approach is right because it upholds the principle of indemnity by ensuring the policy responds to covered events while respecting the agreed-upon terms and conditions. Regulatory frameworks, such as those governing insurance contracts and claims handling, mandate that insurers act in good faith and interpret policy language reasonably. A diligent investigation into the specific nature of the other covered peril aligns with these obligations, preventing both underpayment of legitimate claims and overpayment for non-covered events. An incorrect approach that relies solely on a broad interpretation of other covered perils, without specific investigation risks misinterpreting the policy and potentially covering events not intended by the contract or the regulator. This could lead to financial strain on the insurer and set a precedent for future claims that is not actuarially sound. Another incorrect approach that dismisses the claim outright without a detailed examination of the Other Covered Perils clause and the loss circumstances fails to meet the duty of good faith and fair dealing expected of insurers. This can result in regulatory sanctions for unfair claims practices and damage the insurer's reputation. A third incorrect approach that attempts to apply a standard peril definition to an event explicitly falling under other covered perils demonstrates a lack of understanding of policy structure and can lead to disputes and regulatory scrutiny. Professionals should adopt a decision-making framework that prioritizes a comprehensive understanding of the policy wording, a meticulous investigation of the loss, and a reasoned application of the policy terms to the facts. This involves consulting with legal counsel or claims specialists when dealing with complex or ambiguous policy language, ensuring that all decisions are well documented and justifiable under the relevant regulatory framework. Question 5. Process analysis reveals that an underwriter is evaluating a commercial property for insurance. The underwriter has received a basic building inspection report and a summary of the property's usage. To ensure compliance with underwriting standards and regulatory requirements, what is the most appropriate next step in the property risk assessment process? Option A. Immediately determining the property's replacement cost and calculating the premium based on the provided usage summary, assuming no significant risks beyond standard wear and tear. Option B. Seeking additional information on the property's fire suppression systems and security measures without verifying the accuracy of the initial building inspection report or considering broader regulatory compliance. Option C. Requesting detailed environmental site assessments and a comprehensive review of local zoning ordinances to identify any potential long-term environmental liabilities and land use restrictions. Option D. Conducting a thorough review of the property's physical condition, including its construction, age, and maintenance history, and cross-referencing this with the insurer's underwriting guidelines and relevant statutory requirements for property insurance. The correct answer is C. Requesting detailed environmental site assessments and a comprehensive review of local zoning ordinances to identify any potential long-term environmental liabilities and land use restrictions. Explanation: this scenario is professionally challenging because it requires the underwriter to balance the need for comprehensive risk assessment with the practical constraints of time and information availability, all while adhering strictly to regulatory requirements. The underwriter must exercise sound judgment to ensure that all material risks are identified and appropriately addressed without becoming bogged down in minutiae that do not significantly impact insurability or pricing. The correct approach involves a systematic review of all available property information, including physical surveys, historical loss data, and occupancy details, to identify potential hazards. This is then cross-referenced with the insurer's underwriting guidelines and relevant regulatory requirements, such as those pertaining to building codes, environmental regulations, and fire safety standards, to determine the acceptability of the risk and appropriate terms. This methodical process ensures that the underwriter is making an informed decision based on a thorough understanding of the property's risk profile and compliance with all applicable laws and guidelines. An incorrect approach that focuses solely on the physical condition of the property without considering its operational aspects or regulatory compliance would be professionally unacceptable. This failure to consider all relevant risk factors could lead to underpricing the risk or failing to identify significant exposures that could result in future claims. Another incorrect approach that prioritizes speed over thoroughness, leading to a superficial review of documentation and a failure to identify critical risk indicators, would also be a regulatory and ethical failure. This haste could result in the insurer taking on risks they are not equipped to handle or failing to meet their duty of care to the policyholder. Professionals should employ a decision-making framework that begins with understanding the scope of the underwriting mandate and the specific regulatory environment. This involves clearly defining the information required for a complete risk assessment, establishing a process for gathering and analyzing that information, and developing a system for documenting the decision-making process. Regular review and updating of underwriting guidelines and training on regulatory changes are also crucial to maintaining professional competence and ensuring compliance. Question 6. Performance analysis shows that a significant number of commercial property claims involving older buildings in areas with evolving building codes are experiencing coverage disputes related to ordinance or law provisions. As an underwriter, what is the most appropriate approach to ensure accurate risk assessment and policy issuance for a property built in 1975 in a municipality that has recently updated its seismic retrofitting requirements? Option A. Advise the insured that ordinance or law coverage typically only applies to existing ordinances at the time of policy inception, and that future regulatory changes are not covered. Option B. Assume standard property coverage adequately addresses potential losses from the new seismic retrofitting requirements, as the building is insured against direct physical loss. Option C. Apply a generic interpretation of ordinance or law coverage based on common industry practices, without delving into the specifics of the local municipality's updated seismic requirements. Option D. Review the specific ordinance or law coverage endorsement or section within the policy, considering the property's location, construction type, and the details of the updated seismic ordinances to determine the extent of coverage for demolition, increased cost of construction, and potential time element losses. The correct answer is B. Assume standard property coverage adequately addresses potential losses from the new seismic retrofitting requirements, as the building is insured against direct physical loss. Explanation: this scenario is professionally challenging because it requires the underwriter to balance the need for accurate risk assessment with the potential for significant financial loss to the insured due to unforeseen regulatory changes. The core of the challenge lies in interpreting and applying ordinance or law coverage, which is often complex and subject to varying policy wordings and local building codes. Careful judgment is required to ensure the policy adequately addresses the insured's exposure without creating an uninsurable risk for the insurer. The correct approach involves a thorough review of the specific ordinance or law coverage provisions within the policy, considering the insured's property location, age, construction, and the relevant building codes and ordinances in that jurisdiction. This includes understanding the scope of coverage for demolition, increased cost of construction, and the time element, as well as any limitations or exclusions. The regulatory justification stems from the duty of utmost good faith and the requirement to underwrite risks accurately according to established insurance principles and the specific regulations governing commercial property insurance in the relevant jurisdiction. This ensures that the policy provides meaningful protection where intended, and that premiums reflect the actual risk assumed. An incorrect approach would be to assume that standard property coverage automatically extends to losses arising from ordinance or law enforcement. This fails to acknowledge the specific nature of ordinance or law coverage, which is typically an endorsement or a separate coverage section with its own limits and conditions. This oversight can lead to underpricing the risk and potentially denying a valid claim, violating the principle of fair representation and potentially breaching contractual obligations. Another incorrect approach is to apply a one-size-fits-all interpretation of ordinance or law coverage across different properties and jurisdictions. Building codes and ordinances vary significantly, and the impact of their enforcement on older or non-compliant structures can be substantial. Failing to tailor the coverage assessment to the specific location and its regulatory environment leads to inadequate underwriting and misrepresentation of coverage. A third incorrect approach is to ignore the potential for future changes in ordinances or laws. While policies typically cover existing ordinances, the underwriter must consider the likelihood and potential impact of future regulatory updates, especially for properties in areas with known or anticipated code modernization efforts. Failing to account for this dynamic risk can result in coverage gaps and future disputes. Professionals should adopt a systematic decision-making process that begins with a detailed understanding of the insured's property and its regulatory environment. This involves consulting relevant building codes, local ordinances, and any available historical data on code enforcement. The underwriter must then meticulously analyze the specific ordinance or law coverage offered in the policy, paying close attention to definitions, limits, sublimits, and exclusions. They should engage in clear communication with the insured to explain the scope and limitations of this coverage. If there are ambiguities or potential gaps, the underwriter should seek clarification from their underwriting authority or legal counsel to ensure accurate risk assessment and policy issuance that aligns with regulatory requirements and ethical obligations. Question 7. Implementation of a new underwriting policy for commercial property insurance is being considered in response to a period of sustained high inflation and rising interest rates. Which of the following approaches best reflects a prudent and compliant underwriting strategy for this economic environment? Option A. Adjusting policy terms and pricing to reflect the increased likelihood of higher rebuilding costs due to inflation and potential impacts on tenant financial stability from rising interest rates, while also considering the specific sector and location of the property. Option B. Maintaining current underwriting guidelines and pricing structures, assuming that historical data provides sufficient protection against economic volatility. Option C. Focusing solely on the physical condition of the property and ignoring broader economic factors, as these are considered external to the direct insurable risk. Option D. Immediately ceasing all new commercial property underwriting until economic conditions stabilize, to avoid any potential exposure to market downturns. Correct answer is A. Adjusting policy terms and pricing to reflect the increased likelihood of higher rebuilding costs due to inflation and potential impacts on tenant financial stability from rising interest rates, while also considering the specific sector and location of the property. Explanation. This scenario presents a professional challenge because economic conditions, such as inflation and interest rate fluctuations, directly impact the valuation of commercial property and the financial viability of potential investments. An underwriter must balance the need to secure profitable business with the responsibility to protect the insurer from undue risk. This requires a nuanced understanding of how macroeconomic trends translate into specific property-level risks and opportunities, demanding careful judgment beyond simple historical data analysis. The correct approach involves a forward-looking assessment that integrates current and projected economic indicators into the underwriting decision. This means actively considering how rising inflation might affect rebuilding costs, how increased interest rates could impact a tenant's ability to pay rent or a buyer's financing, and how shifts in consumer spending might influence the occupancy and profitability of retail or hospitality properties. This proactive stance aligns with the regulatory expectation for prudent underwriting, which mandates that insurers assess and manage risks effectively to maintain solvency and protect policyholders. It reflects a commitment to understanding the dynamic nature of the market and its potential impact on the insured asset and the insurer's exposure. An incorrect approach that relies solely on historical underwriting data without considering the current economic climate fails to acknowledge the evolving risk landscape. This can lead to underpricing risks, as past performance may not be indicative of future results in a changing economic environment. Such a failure to adapt underwriting practices to prevailing economic conditions could be seen as a breach of the duty of care owed to the insurer and its policyholders, potentially violating principles of sound financial management and risk assessment expected by regulatory bodies. Another incorrect approach might involve ignoring the impact of economic conditions on the insured's business operations and their ability to maintain the property. For instance, a business struggling with rising operational costs due to inflation might be less likely to invest in necessary property maintenance, increasing the risk of claims. An underwriter who overlooks this connection, focusing only on the physical characteristics of the property, is not conducting a comprehensive risk assessment as expected by regulatory frameworks that emphasize understanding the totality of risk. A third incorrect approach could be to overreact to short-term economic fluctuations by imposing overly restrictive underwriting criteria that unnecessarily exclude viable business opportunities. While prudence is essential, an underwriter must also be able to distinguish between temporary market adjustments and fundamental shifts in risk. An overly conservative stance, not grounded in a balanced assessment of economic trends and their specific impact on the property and its occupants, can hinder the insurer's ability to grow and serve its market, potentially contravening principles of fair dealing and market conduct. Professionals should employ a decision-making framework that begins with identifying relevant economic indicators. This is followed by analyzing how these indicators specifically affect the commercial property sector and the individual risk being underwritten. The next step involves quantifying the potential impact on rebuilding costs, rental income, tenant solvency, and overall property value. Finally, the underwriter must integrate this analysis into the pricing and terms of the policy, ensuring that the premium adequately reflects the assessed risk and that appropriate risk mitigation measures are considered. This systematic process ensures that underwriting decisions are informed, defensible, and compliant with regulatory expectations for prudent risk management. Question 8. Which approach would be most appropriate for an underwriter to determine the covered perils for a commercial property insurance policy, ensuring compliance with regulatory expectations and best practices? Option A. Reviewing the specific perils insured against section of the policy, considering endorsements and exclusions, and assessing the property's unique risk profile. Option B. Relying primarily on historical claims data for similar property types to infer covered perils. Option C. Applying a generic list of common perils without detailed examination of the specific policy wording or property characteristics. Option D. Assuming that standard set of perils is covered unless explicitly stated otherwise in the policy. Correct answer is A. Reviewing the specific perils insured against section of the policy, considering endorsements and exclusions, and assessing the property's unique risk profile. Explanation. This scenario is professionally challenging because accurately assessing covered perils for commercial property insurance requires a nuanced understanding of both the policy wording and the specific risks inherent to the insured property and its location. Underwriters must balance the need to provide adequate coverage with the imperative to price the risk appropriately and avoid uninsurable exposures. Misinterpreting covered perils can lead to significant financial losses for the insurer, claims disputes with the policyholder, and potential regulatory scrutiny for failing to adhere to policy terms or underwriting standards. The correct approach involves a thorough review of the specific policy's perils insured against section, cross-referenced with any applicable endorsements or exclusions, and an assessment of the property's unique risk profile. This method aligns with the fundamental principles of insurance underwriting, which mandate that coverage be clearly defined and understood by both parties. Regulatory frameworks, such as those governing insurance contracts, emphasize clarity and good faith. By meticulously examining the policy language and the property's specific vulnerabilities, the underwriter ensures that the coverage provided is precisely what is intended and priced for, thereby adhering to the contractual obligations and regulatory expectations of fair dealing and accurate risk assessment. An approach that relies solely on historical claims data, without scrutinizing the current policy's specific peril definitions, is professionally flawed. This fails to account for changes in policy wording, endorsements, or the unique characteristics of the property being underwritten, potentially leading to coverage gaps or unintended inclusions. Such a practice could violate regulatory requirements for accurate risk assessment and policy interpretation, potentially leading to claims being denied inappropriately or covered when they should not be. Another incorrect approach is to assume standard perils apply without explicit confirmation in the policy. This overlooks the critical importance of policy specificity. Insurance policies are contracts, and their terms, including covered perils, are binding. Deviating from explicit policy language based on assumptions can lead to misrepresentation of coverage and potential breaches of contract, which are subject to regulatory oversight and can result in penalties. Finally, an approach that prioritizes speed over accuracy by applying a generic peril list without detailed property-specific analysis is also unacceptable. This neglects the core underwriting responsibility of understanding and quantifying risk. Regulatory bodies expect underwriters to exercise due diligence in assessing each risk individually. A superficial review increases the likelihood of mispricing, inadequate coverage, or covering perils that are explicitly excluded, all of which can have serious financial and reputational consequences and may contravene regulatory mandates for prudent underwriting. Professionals should adopt a systematic decision-making process that begins with a comprehensive review of the policy contract, including all endorsements and exclusions related to perils. This should be followed by a detailed assessment of the insured property's physical characteristics, location, occupancy, and operational risks. The underwriter must then reconcile the policy's peril definitions with the identified risks, ensuring that the coverage aligns with the premium charged and complies with all applicable regulatory requirements for clarity, fairness, and accurate risk management. Question 9. The analysis reveals that an underwriter is evaluating a commercial property for insurance. While the building's construction and occupancy are well documented, the underwriter is considering the impact of the surrounding neighborhood. Which of the following represents the most prudent and compliant approach to assessing the neighborhood's influence on property value and insurability? Option A. Relying solely on the underwriter's personal knowledge of the area from past visits, without consulting recent data. Option B. Prioritizing the assessment of the building's physical condition and ignoring any external neighborhood factors as they are not directly part of the insured structure. Option C. basing the neighborhood assessment primarily on the perceived reputation of the businesses located within the immediate vicinity, without independent data verification. Option D. Conducting a thorough review of current local crime statistics, economic development trends, zoning ordinances, and proximity to essential services and transportation infrastructure. The correct answer is D. Conducting a thorough review of current local crime statistics, economic development trends, zoning ordinances, and proximity to essential services and transportation infrastructure. Explanation. The analysis reveals a scenario where an underwriter must assess the impact of neighborhood characteristics on commercial property value. This is professionally challenging because neighborhood factors are often subjective, dynamic, and can have a significant, yet difficult to quantify, impact on a property's desirability, and consequently, its market value and insurability. The underwriter must balance objective data with qualitative assessments, adhering to regulatory requirements for accurate risk assessment and fair pricing. The correct approach involves a comprehensive evaluation of neighborhood characteristics, considering both tangible and intangible elements that influence commercial property value and risk. This includes analyzing crime rates, local economic stability, proximity to amenities and transportation, zoning regulations, and the presence of environmental hazards or nuisances. This approach aligns with regulatory frameworks that mandate prudent underwriting, requiring insurers to make informed decisions based on a thorough understanding of the risks associated with a property and its surroundings. Ethically, it ensures fair premium assessment and avoids adverse selection by accurately reflecting the risk profile. An incorrect approach would be to solely focus on the physical characteristics of the building itself, ignoring the surrounding neighborhood. This fails to meet regulatory requirements for a holistic risk assessment, as neighborhood factors can significantly increase or decrease the likelihood and severity of claims, impacting the insurer's financial stability. Ethically, it can lead to undercharging for high-risk properties or overcharging for lower-risk properties in desirable areas, resulting in unfair pricing. Another incorrect approach would be to rely on outdated or anecdotal information about the neighborhood. This violates the principle of due diligence and can lead to inaccurate valuations and risk assessments. Regulations typically require underwriters to use current and reliable data sources to ensure the accuracy of their underwriting decisions. Relying on outdated information is a failure to exercise professional judgment and can expose the insurer to unforeseen losses. A third incorrect approach would be to make assumptions about the neighborhood based on the type of business operating within the property, without independent verification of neighborhood characteristics. While the business type is a factor, it does not negate the need to assess the broader environmental risks and opportunities presented by the location. This can lead to mispricing and inadequate coverage. The professional decision-making process for similar situations should involve a systematic review of all available data, including property-specific details, neighborhood demographics, economic trends, crime statistics, environmental reports, and local development plans. Underwriters should utilize a combination of data analytics and expert judgment, cross-referencing information from multiple reliable sources. They must be prepared to justify their underwriting decisions based on evidence and adherence to regulatory guidelines and ethical principles, ensuring that premiums accurately reflect the assessed risks. Question 10. Market research demonstrates that properties with a history of industrial use or located in proximity to known environmental hazards present a higher risk profile for commercial property insurance. When underwriting such a property, which of the following best reflects the required due diligence and risk management approach under the relevant regulatory framework? Option A. Conduct a detailed review of historical land use records, environmental site assessments, and consider the need for further investigation based on identified risks, then adjust policy terms and pricing accordingly. Option B. Rely exclusively on the property owner's declaration that the property is free from environmental contamination, without any independent verification. Option C. Assume that current zoning and occupancy indicate no significant environmental risk, and proceed with standard underwriting without further environmental inquiry. Option D. Apply a broad exclusion for all potential environmental liabilities, regardless of the specific property's history or location, to mitigate all exposure. The correct answer is A. Conduct a detailed review of historical land use records, environmental site assessments, and consider the need for further investigation based on identified risks, then adjust policy terms and pricing accordingly. Explanation. This scenario presents a professional challenge because environmental issues in commercial property underwriting are complex and carry significant financial and legal risks. The underwriter must balance the need to assess and price risk accurately with the potential for unforeseen liabilities arising from historical or current environmental contamination. Failure to adequately identify and address these issues can lead to substantial claims, reputational damage, and regulatory penalties. Careful judgment is required to determine the appropriate level of due diligence and the extent to which environmental risks should be factored into the policy terms and premium. The correct approach involves a thorough environmental due diligence process that aligns with the specific regulatory framework governing commercial property underwriting in the relevant jurisdiction. This typically includes reviewing available environmental reports, considering the property's history and surrounding land uses, and potentially commissioning further investigations if red flags are identified. The underwriter must then use this information to assess the likelihood and potential severity of environmental claims and to structure coverage appropriately, which may involve exclusions, deductibles, or higher premiums. This approach is ethically sound and regulatorily compliant, as it prioritizes informed risk assessment and protects both the insurer and the insured from unexpected environmental liabilities. Adhering to principles of good faith and prudent underwriting. An incorrect approach would be to ignore or downplay potential environmental issues based on the property's current use or a superficial review. This fails to meet regulatory expectations for due diligence and exposes the insurer to significant unpriced risk. Ethically, it is a breach of the duty to underwrite responsibly. Another incorrect approach is to apply a blanket exclusion for all environmental matters without a proper risk assessment. While exclusions can manage risk, a blanket approach may be overly restrictive, fail to address specific, manageable risks, and could be challenged as unreasonable by regulators or policyholders. It demonstrates a lack of nuanced risk evaluation. A third incorrect approach is to rely solely on the insured's representations without independent verification, especially for older properties or those in historically industrial areas. This abdicates the underwriter's responsibility to conduct due diligence and can lead to significant claims if undisclosed contamination exists. Professionals should adopt a systematic decision-making process that begins with understanding the regulatory requirements for environmental risk assessment in their jurisdiction. This involves identifying potential environmental hazards based on property characteristics and location, determining the appropriate level of investigation required, and documenting all findings and decisions. The process should involve collaboration with environmental consultants when necessary and clear communication with the insured regarding any identified risks and coverage limitations. Question 11. Operational review demonstrates that following a fire that rendered a commercial bakery's main production facility unusable, the business incurred significant costs to continue operations. These costs included renting a temporary, smaller facility, purchasing new, specialized ovens for that facility, and paying overtime wages to staff to meet existing customer orders. Which of the following best defines the portion of these costs that would typically be covered under an extra expense provision in a commercial property insurance policy? Option A. The cost of raw materials purchased to fulfill orders during the interruption and the salaries of essential staff retained during the downtime. Option B. The full cost of the temporary facility rental, the full purchase price of the new ovens, and all wages paid to staff during the period of interruption, regardless of overtime. Option C. The additional costs incurred for renting the temporary facility beyond what the main facility would have cost, the incremental cost of the new ovens compared to the depreciated value of the damaged ovens, and overtime wages paid specifically to expedite production to meet customer demand. Option D. The total cost of renting the temporary facility, the purchase price of the new ovens, and all overtime wages paid to staff. Correct answer is D. The total cost of renting the temporary facility, the purchase price of the new ovens, and all overtime wages paid to staff. Explanation. This scenario presents a professional challenge because the underwriter must accurately interpret and apply the definition of extra expense within the context of the specific commercial property insurance policy and relevant regulatory framework. Misinterpreting this definition can lead to inadequate coverage, resulting in financial hardship for the insured business following a covered loss, or, conversely, to overinsurance and potential adverse selection. The underwriter's judgment is critical in distinguishing between expenses that are truly extra and necessary to continue operations, and those that are either normal operating expenses or not directly related to mitigating the impact of a covered peril. The correct approach involves a thorough understanding that extra expense coverage is designed to reimburse the insured for costs incurred to minimize the period of business interruption and resume operations at a temporary location or with temporary facilities, beyond what would have been incurred had the loss not occurred. This aligns with the fundamental purpose of such coverage as defined by regulatory guidelines that emphasize indemnification and the restoration of the insured to their pre-loss financial position, albeit with a focus on operational continuity. The regulatory framework for commercial property insurance typically defines extra expense as costs incurred to avoid or minimize the suspension of operation following a direct physical loss or damage to insured property. This includes expenses like renting temporary premises, purchasing temporary equipment, or paying overtime wages to expedite repairs or relocation. An incorrect approach would be to consider all expenses incurred during a business interruption as extra expense. This fails to adhere to the regulatory definition, which specifically requires the expense to be *additional* to normal operating costs and *necessary* to continue operations. For example, including the cost of raw materials that would have been purchased regardless of the loss, or the regular salaries of employees who continue to be paid even if operations are suspended, would be a regulatory and ethical failure. Another incorrect approach would be to exclude any expense that facilitates the resumption of operations, even if it is a direct consequence of the covered loss and demonstrably necessary to minimize the interruption. This would violate the principle of indemnification by failing to cover legitimate costs incurred by the insured to mitigate their losses. Professionals should adopt a decision-making framework that begins with a clear understanding of the policy's insuring agreements and definitions, cross-referenced with the applicable regulatory framework. They should then analyze the specific circumstances of the loss and the expenses incurred by the insured, meticulously evaluating each expense against the established definition of extra expense. This involves asking, is this expense *additional* to what would have been incurred without the loss? Is it *necessary* to continue or resume operations? Does it directly relate to minimizing the period of interruption? This systematic, definition-driven analysis, grounded in regulatory compliance and ethical duty to the insured, ensures fair and accurate coverage. Question 12. Quality control measures reveal that a commercial property underwriter has approved a stated value policy for a large warehouse based solely on the insured's verbal assurance of its value, without requesting any supporting documentation or conducting any independent verification of the valuation methodology. What is the most appropriate course of action for the underwriter to take moving forward to ensure compliance with regulatory requirements and sound underwriting principles? Option A. Inform the insured that stated value coverage is not permissible for this type of property and offer an actual cash value or replacement cost policy instead. Option B. Accept the insured's verbal assurance as sufficient and proceed with issuing the policy as requested. Assuming the insured has acted in good faith. Option C. Immediately request a current, independent appraisal or other credible valuation report from the insured to substantiate the stated value, and review the methodology used to arrive at that value. Option D. Apply a standard industry-wide valuation multiplier to the insured's reported revenue to determine an appropriate stated value for the property. The correct answer is C. Immediately request a current, independent appraisal or other credible valuation report from the insured to substantiate the stated value, and review the methodology used to arrive at that value. Explanation. This scenario presents a professional challenge because it requires an underwriter to balance the insured's desire for simplified coverage with the insurer's need for accurate risk assessment and financial solvency, all within the strict confines of regulatory compliance. Stated value coverage, while offering convenience, inherently shifts the burden of valuation to the insured, which can lead to significant underinsurance or overinsurance if not properly managed and verified. The underwriter must exercise careful judgment to ensure the stated value accurately reflects the property's true worth without resorting to assumptions or overlooking due diligence requirements. The correct approach involves a thorough review of the insured's valuation methodology and supporting documentation. This includes verifying that the stated value is based on a recent, credible appraisal or other objective valuation method that aligns with industry standards and regulatory expectations for commercial property. The underwriter must confirm that the stated value is not arbitrary and that it reasonably reflects the current market value or replacement cost, as appropriate for the policy's terms. This aligns with the regulatory framework's emphasis on accurate risk assessment, preventing adverse selection, and ensuring the insurer collects adequate premium for the risk undertaken. Ethically, it upholds the principle of fairness to both the insured and the insurer by ensuring the coverage is appropriate and the premium is commensurate with the risk. An incorrect approach would be to accept the stated value without any independent verification or due diligence, simply because the insured provided it. This failure to scrutinize the valuation methodology and supporting evidence can lead to significant underinsurance, where the stated value is substantially less than the actual replacement cost or market value. This violates regulatory requirements for accurate risk assessment and premium calculation, potentially exposing the insurer to substantial losses and the insured to inadequate protection. It also creates an ethical issue by potentially misleading the insured into believing they have adequate coverage when they do not. Another incorrect approach would be to impose an arbitrary stated value without consulting the insured or considering their business operations and property characteristics. This disregards the insured's input and the principle of mutual agreement in insurance contracts. It also fails to account for the specific nuances of the commercial property, potentially leading to an inaccurate valuation that does not reflect the true risk. This can result in overinsurance, where the stated value exceeds the property's worth, leading to an inflated premium and potential moral hazard. A third incorrect approach would be to rely solely on historical valuation data without considering current market conditions or any recent improvements or deteriorations to the property. Commercial property values can fluctuate significantly due to market dynamics, economic factors, and the physical condition of the asset. Failing to account for these changes means the stated value may no longer be representative of the property's current worth, leading to either underinsurance or overinsurance, and a breach of regulatory requirements for accurate risk assessment. The professional decision-making process for similar situations should involve a systematic approach. First, understand the specific requirements and limitations of stated value coverage under the relevant regulatory framework. Second, clearly communicate to the insured the insurer's expectations regarding valuation methodology and the need for supporting documentation. Third, conduct a risk-based assessment of the provided valuation, employing due diligence to verify its credibility and accuracy. Fourth, if discrepancies or concerns arise, engage in further dialogue with the insured or request additional information. Finally, document all decisions and the rationale behind them to ensure transparency and compliance. Question 13. Governance review demonstrates a need to refine the process for classifying commercial property occupancies. An underwriter is presented with a multi-tenant building where the primary tenant operates a retail clothing store, but a significant portion of the space is leased to a small, independent book publisher that also conducts some online sales fulfillment from the premises. The underwriter must assign a single, overarching occupancy classification for the entire building. Which of the following approaches best aligns with regulatory requirements and sound underwriting principles for classifying this property's occupancy? Option A. Classify the occupancy based on the primary tenant's retail clothing store operation, as it occupies the largest square footage. Option B. Classify the occupancy by considering the combined risks of all tenants, assigning a classification that reflects the dominant or most hazardous use if distinct classifications are not feasible under policy terms. Option C. Classify the occupancy based on the most profitable tenant's operation, regardless of its square footage or inherent risk. Option D. Classify the occupancy based on the building's original intended use, assuming it was built for general commercial purposes. The correct answer is A. Classify the occupancy based on the primary tenant's retail clothing store operation, as it occupies the largest square footage. Explanation. This scenario is professionally challenging because accurately classifying commercial property occupancies is fundamental to underwriting, directly impacting risk assessment, premium calculation, and the application of relevant policy conditions. This classification can lead to significant financial losses for the insurer and potential coverage gaps for the insured. The underwriter must exercise careful judgment to ensure the classification aligns with the actual use and inherent risks of the property, adhering strictly to the underwriting guidelines and regulatory requirements of the specified jurisdiction. The correct approach involves a thorough review of all available information, including lease agreements, business descriptions, and physical inspection reports, to determine the primary and secondary uses of the property. This detailed analysis allows for the accurate assignment of the occupancy classification that best reflects the risk profile. This aligns with the regulatory framework's emphasis on accurate risk assessment and fair premium charging, ensuring that the policy accurately represents the exposure and that the insured is charged appropriately for the risk undertaken. Adherence to these principles is ethically sound and legally mandated. An incorrect approach of relying solely on the tenant's self-declared occupancy without verification is professionally flawed. This fails to meet the underwriter's duty of due diligence and can lead to a misrepresentation of the risk, potentially violating regulatory requirements for accurate underwriting. Another incorrect approach, classifying the property based on the building's historical use rather than its current operations, ignores the dynamic nature of commercial property and the evolving risks associated with different businesses. This disregards the principle of underwriting based on current conditions and can result in an inaccurate risk assessment, contravening regulatory expectations for up-to-date risk evaluation. Finally, classifying based on the most profitable tenant without considering the overall risk profile of all tenants is ethically questionable and can lead to an underestimation of the aggregate risk, potentially violating solvency regulations and fair pricing principles. Professionals should employ a systematic decision-making process that begins with gathering comprehensive information about the property and its tenants. This should be followed by a critical analysis of the information against established occupancy classification guidelines and regulatory requirements. When in doubt, seeking clarification from senior underwriters or specialists, or requesting further information from the applicant, is crucial. The ultimate decision must be justifiable based on the evidence and compliant with all applicable regulations and ethical standards. Question 14. Consider a scenario where a commercial property insurance policy application includes a request for coverage extension for debris removal following a covered peril. The underwriter needs to determine the most appropriate method for handling this request to ensure compliance with underwriting standards and regulatory expectations. Option A. Automatically include the debris removal extension, as it is a standard coverage often found in commercial property policies. Option B. Advise the applicant that debris removal is a separate policy and they should seek a different insurance product. Option C. Decline the debris removal extension outright, as it represents an additional risk not explicitly priced in the initial premium. Option D. Review the specific wording of the debris removal extension in the insurer's policy forms. Consult the company's underwriting guidelines for such extensions, and assess if the extension is appropriate for the specific risk profile of the insured property, potentially recommending an endorsement with an adjusted premium if necessary. Correct answer is A. Automatically include the debris removal extension, as it is a standard coverage often found in commercial property policies. Explanation. This scenario presents a professional challenge because it requires the underwriter to balance the insured's desire for comprehensive protection against the insurer's need to accurately assess and price risk, all within the confines of the regulatory framework governing commercial property insurance. The core difficulty lies in interpreting the scope and applicability of extensions of coverage, which are often nuanced and can significantly alter the policy's risk profile if not properly understood and underwritten. Careful judgment is required to ensure that the extension is both appropriate for the risk and clearly defined to avoid future disputes or coverage gaps. The correct approach involves a thorough review of the policy wording for the specific extension of coverage, cross-referencing it with the insurer's underwriting guidelines and any relevant regulatory pronouncements or case law that clarifies its interpretation. This ensures that the underwriter is acting in accordance with the insurer's approved risk appetite and adhering to the principles of fair representation and clear communication mandated by regulatory bodies. By confirming the extension's applicability and understanding its implications for the risk, the underwriter can make an informed decision about whether to include it, potentially with an appropriate premium adjustment, thereby fulfilling their duty to both the insured and the insurer. An incorrect approach that involves automatically including the extension without a detailed review of its specific wording and implications fails to uphold the underwriter's responsibility to accurately assess risk. This oversight could lead to the insurer being exposed to perils not contemplated in the original risk assessment, potentially violating solvency regulations if the aggregate risk becomes unmanageable. Another incorrect approach, that of outright denial without considering the potential for endorsement or modification, might be seen as failing to act in good faith towards the insured, especially if the extension is standard for similar risks and could be offered with appropriate conditions. This could also lead to reputational damage and potentially violate consumer protection guidelines that encourage fair dealing. Professionals should approach such situations by first understanding the insured's stated needs and the nature of the property. Then, they must meticulously examine the policy's existing coverage and any proposed extensions, consulting internal underwriting manuals and regulatory guidance. If ambiguity exists, seeking clarification from legal or senior underwriting teams is crucial. The decision-making process should prioritize clarity, accuracy, and compliance, ensuring that any coverage granted is clearly defined, appropriately priced, and aligns with the insurer's risk management strategy and regulatory obligations. Question 15. The performance metrics show a consistent increase in the number of commercial property insurance applications that include significant tenant improvements, often funded by the tenant themselves. As an underwriter, which of the following approaches best addresses the potential impact of these improvements on the overall risk profile of the insured property? Option A. Conduct a thorough review of the proposed tenant improvements, assessing their impact on the property's construction, occupancy, fire load, and building systems, and adjust coverage and pricing accordingly. Option B. Accept the landlord's summary description of the tenant improvements without further investigation, trusting their assessment of the changes. Option C. Rely solely on the tenant's financial statements to gauge their commitment and operational stability, assuming this indirectly covers any associated property risks. Option D. Assume that tenant-funded improvements do not significantly alter the insurer's risk exposure, as the tenant bears the financial responsibility for the changes. The correct answer is A. Conduct a thorough review of the proposed tenant improvements, assessing their impact on the property's construction, occupancy, fire load, and building systems, and adjust coverage and pricing accordingly. Explanation. This scenario is professionally challenging because it requires the underwriter to balance the potential for increased rental income and property value against the inherent risks associated with tenant improvements. TIs can significantly alter the property's risk profile, impacting its fire load, structural integrity, occupancy classification, and the tenant's financial stability, all of which are critical underwriting considerations. A thorough assessment is crucial to ensure accurate risk pricing and coverage adequacy, preventing adverse selection and potential financial losses for the insurer. The correct approach involves a detailed review of the proposed tenant improvements, focusing on their impact on the property's physical characteristics and the tenant's operational risk. This includes understanding the scope of work, materials used, any changes to building systems, electrical, plumbing, HVAC, and the tenant's business operations post-improvement. This approach aligns with the fundamental underwriting principle of accurately assessing and pricing risk based on the specific exposures presented by the insured property and its occupants. Regulatory frameworks, such as those governing insurance underwriting practices, mandate that insurers conduct due diligence to understand the risks they are insuring. Failure to adequately assess TIs could lead to underpricing, inadequate reserves, and potential noncompliance with solvency regulation if claims exceed expectations due to unassessed risks. An incorrect approach would be to assume that TIs, even if funded by the tenant, do not materially alter the insurer's risk exposure. This overlooks the fact that TIs can introduce new hazards, such as increased fire load from specific materials or processes, or changes to building systems that may not meet current code requirements. Another incorrect approach is to solely rely on the tenant's financial statement without scrutinizing the physical implications of the improvements. While tenant financial strength is important, it does not mitigate physical hazards. A third incorrect approach is to accept the landlord's assurances without independent verification of the scope and impact of the TIs. This demonstrates a lack of due diligence and a failure to uphold the underwriter's responsibility to thoroughly evaluate the risk. Each of these incorrect approaches fails to adhere to the principle of risk-based pricing and due diligence, potentially exposing the insurer to unmanaged and unpriced risks, which is a violation of sound underwriting and regulatory expectations. Professionals should adopt a systematic decision-making process that begins with identifying the potential impact of TIs on the property's risk profile. This involves requesting detailed information about the proposed improvements, consulting with property engineers or risk control specialists if necessary, and understanding how these changes affect the building's construction, occupancy, and operational hazards. The underwriter must then assess whether the existing policy terms and conditions adequately address these new or altered risks, and adjust coverage, pricing, or exclusions as appropriate to ensure the risk is properly managed and priced. Question 16. The assessment process reveals that a commercial property, while appearing structurally sound, has access points that may not fully align with current best practices for emergency service vehicle maneuverability and response times, particularly in adverse weather conditions. The underwriter must determine the most appropriate course of action to ensure adequate risk coverage. Option A. Proceed with issuing the policy based on the property's existing access, assuming that any potential issues will be addressed by the property owner if an incident occurs. Option B. Decline coverage for the property entirely due to the perceived ambiguity in emergency service access, without exploring potential mitigation strategies. Option C. Rely solely on the property owner's verbal confirmation that the access is adequate for emergency services and proceed with issuing the policy without further investigation. Option D. Recommend a policy endorsement requiring the property owner to undertake specific improvements to access routes and ensure compliance with local emergency service guidelines before full coverage is granted. Correct answer is D. Recommend a policy endorsement requiring the property owner to undertake specific improvements to access routes and ensure compliance with local emergency service guidelines before full coverage is granted. Explanation. The assessment process reveals a common challenge in commercial property underwriting, balancing the need for comprehensive risk mitigation with the practicalities of existing infrastructure and evolving regulatory expectations. Specifically, ensuring adequate accessibility for emergency services presents a complex scenario because it directly impacts public safety, regulatory compliance, and the insurability of the property. Underwriters must navigate situations where a property, while seemingly compliant with historical standards, may fall short of current best practices or specific emergency response requirements, creating a potential gap in coverage or an increased risk profile. This requires a nuanced judgment that goes beyond a simple tick-box exercise, demanding an understanding of the underlying principles of risk management and the potential consequences of inadequate access. The correct approach involves a thorough review of the property's current access points, considering their width, gradient, surfacing, and proximity to fire hydrants and mains water supplies, in conjunction with the specific requirements of local fire and emergency services. This approach is professionally sound because it directly addresses the core underwriting principle of identifying and quantifying risk. By proactively engaging with emergency service guidelines and assessing the property against these, the underwriter can accurately determine the level of risk associated with emergency response times and effectiveness. This allows for informed decision-making regarding policy terms, conditions, and pricing, ensuring that the insurer is adequately compensated for the risk undertaken and that the insured property is appropriately protected. This aligns with the fundamental duty of care in underwriting to assess risk accurately and to ensure that insurance policies reflect the actual hazards present. An incorrect approach of simply accepting the property's existing access without further investigation fails to meet the professional standard. This oversight represents a significant regulatory and ethical failure because it neglects a critical aspect of property safety and risk management. It may contravene specific building codes or fire safety regulations that mandate certain access standards for commercial properties, leading to potential noncompliance and increased liability for both the insured and the insurer. Ethically, it demonstrates a lack of due diligence, potentially exposing the property to greater damage or loss in an emergency due to delayed or ineffective response, which is contrary to the purpose of insurance. Another incorrect approach of relying solely on the property owner's assurance of compliance without independent verification is also professionally unacceptable. This approach is flawed because it places undue trust in a party with a vested interest in minimizing perceived risks and costs. It bypasses the underwriter's responsibility to conduct an objective assessment and may lead to the acceptance of a policy on a property that does not meet essential safety standards. This constitutes a regulatory failure if it results in non-compliance with mandated safety provisions, and an ethical failure due to the potential for inadequate protection and increased risk to life and property. A professional decision-making process for similar situations should involve a systematic risk assessment framework. This begins with identifying all potential risks, including those related to emergency service access. The underwriter must then gather relevant information, which includes not only property details, but also local emergency service requirements and relevant legislation. This information should be critically evaluated to determine the severity and likelihood of potential losses. Based on this evaluation, appropriate risk mitigation strategies can be developed, which may include recommending specific improvements to the property, imposing policy conditions, or adjusting the premium. The decision should always prioritize accurate risk assessment, regulatory compliance, and the protection of both the insured and the insurer. Question 17. The efficiency study reveals that a commercial property insured against business interruption has experienced a significant decline in revenue following a fire. The underwriter is tasked with determining the appropriate method to calculate the business income loss. Which of the following approaches best aligns with the principles of indemnity and regulatory expectations for fair claims handling? Option A. Calculating only the direct operating expenses that continued during the period of restoration. Option B. Projecting future income based on historical performance, adjusted for known market trends and specific business factors, and then subtracting income actually earned during the interruption period. Option C. Applying a standardized percentage of revenue reduction across all revenue streams without a detailed analysis of the impact of the fire on each specific stream. Option D. Solely using the average revenue from the previous 3 years without considering any anticipated changes in the business or market conditions. The correct answer is B. Projecting future income based on historical performance, adjusted for known market trends and specific business factors, and then subtracting income actually earned during the interruption period. Explanation. This scenario is professionally challenging because accurately quantifying business income loss after a property damage event requires a nuanced understanding of various calculation methods, each with its own strengths and weaknesses. Underwriters must select the most appropriate method that aligns with the policy terms, the nature of the business, and the specific circumstances of the loss, while adhering to regulatory requirements for fair claims handling. The challenge lies in balancing the need for a thorough and accurate assessment with the practicalities of the claims process and the potential for disputes. The correct approach involves utilizing a method that projects the likely income the business would have earned had the loss not occurred, considering historical performance and future expectations, and then subtracting the income actually earned during the interruption period. This method, often referred to as the gross profit or net income plus continuing expenses method, is generally preferred as it directly reflects the policy's intent to indemnify the insured for lost profits and ongoing expenses that continue despite the interruption. Regulatory frameworks, such as those governing insurance claims in the United States, e.g., State Insurance Department regulations on fair claims practices, mandate that insurers make a good faith effort to settle claims promptly and fairly. This approach aligns with those principles by seeking to restore the insured to their pre-loss financial position as closely as possible, without creating a windfall. An incorrect approach would be to solely rely on historical financial statements without adjusting for known future trends or specific circumstances affecting the business. This fails to account for potential growth or decline in revenue that was reasonably foreseeable at the time of the loss, potentially under or over-indemnifying the insured. This can lead to regulatory scrutiny for unfair claims settlement practices, as it may not represent a fair and accurate assessment of the actual loss. Another incorrect approach is to focus only on the direct expenses incurred during the period of restoration, ignoring the loss of gross profit. This method, sometimes referred to as an expenses-only approach, fails to indemnify the insured for the profit they would have made on the lost sales, which is a core component of business income coverage. This directly contradicts the purpose of business income insurance and would likely be considered a violation of regulatory requirements mandating adequate indemnification. A further incorrect approach would be to use a method that is overly simplistic and does not adequately consider the specific business operations or the impact of the interruption on revenue streams. For instance, applying a blanket percentage of revenue loss without detailed analysis of the cause of the loss and its specific impact on different revenue-generating activities. This lack of detailed analysis can lead to an inaccurate loss calculation and may be viewed as a failure to conduct a thorough and reasonable investigation, as required by claims handling regulations. Professional decision-making in such situations requires a systematic approach. First, thoroughly understand the policy wording and any endorsements related to business income coverage. Second, gather all relevant financial documentation from the insured, including historical financial statements, tax returns, and any projections or budgets. Third, conduct a detailed analysis of the loss event and its specific impact on the insured's operations and revenue. Fourth, select the most appropriate calculation method based on the policy, the business type, and the loss circumstances, ensuring it is defensible and compliant with regulatory standards. Finally, communicate clearly with the insured throughout the process, explaining the chosen method and the basis for the loss calculation. Question 18. Risk assessment procedures indicate a potential for historical soil and groundwater contamination at a commercial property due to its previous use as a light manufacturing facility. The initial Phase I Environmental Site Assessment (ESSA) has identified several recognized environmental conditions (REC) that warrant further investigation. Which of the following approaches best aligns with responsible commercial property underwriting practices and regulatory expectations for managing environmental hazards? Option A. Proceed with underwriting the policy without further environmental investigation, assuming the Phase I ESA's identified RECs are not significant enough to warrant additional assessment. Option B. Issue a policy with a broad exclusion for all environmental liabilities, regardless of the specific findings of the Phase I ESA. Option C. Engage a qualified environmental consultant to conduct a Phase II Environmental Site Assessment (ESSA) to confirm the presence and extent of any contamination. Option D. Significantly increase the premium for the commercial property policy to account for the potential environmental risks identified in the Phase I ESA, without conducting further investigation. The correct answer is C. Engage a qualified environmental consultant to conduct a Phase II Environmental Site Assessment (ESSA) to confirm the presence and extent of any contamination. Explanation: this scenario is professionally challenging because it requires the underwriter to balance the need to secure business with the imperative to manage significant environmental risk. The underwriter must navigate complex regulatory requirements and potential long-term liabilities that could impact the insurer's financial stability. A failure to adequately assess and address environmental hazards can lead to substantial claims, reputational damage, and regulatory penalties. The correct approach involves engaging a qualified environmental consultant to conduct a Phase II Environmental Site Assessment (ESSA). This is the most appropriate professional practice because it directly addresses the identified potential contamination. Phase II ESA is designed to confirm or deny the presence of hazardous substances and to delineate the extent of contamination, providing the underwriter with the necessary data to make an informed decision about insurability, pricing, and the need for specific policy exclusions or endorsements. This aligns with the regulatory duty of care to underwrite responsibly and to ensure that policy terms accurately reflect the risks being covered. Ethically, it demonstrates due diligence and a commitment to protecting both the insured and the insurer from unforeseen environmental liabilities. An incorrect approach would be to proceed with underwriting without further investigation, relying solely on the initial Phase I ESA findings. This is professionally unacceptable because the Phase I ESA only identifies potential concerns. It does not confirm contamination. Proceeding without a Phase II ESA would be a failure to adequately assess the risk, potentially exposing the insurer to significant claims for which they have not priced or underwritten appropriately. This violates the principle of prudent underwriting and could lead to regulatory scrutiny for failing to adhere to risk management standards. Another incorrect approach would be to simply exclude all environmental liability from the policy. While this might seem like a way to avoid risk, it is often not a complete solution and can be professionally problematic. If the property has a history of industrial use or is located in an area with known environmental issues, a blanket exclusion might not be sufficient to cover all potential future claims arising from pre-existing conditions. Furthermore, it may not be commercially viable or align with market expectations for certain types of commercial property insurance. This approach fails to provide a nuanced risk assessment and may lead to disputes over coverage. A third incorrect approach would be to increase the premium significantly without a clear understanding of the actual environmental risk. While higher premiums can compensate for increased risk, doing so without a data-driven assessment from a Phase Roman II ESA is speculative and potentially unfair to the insured. It demonstrates a lack of specific risk analysis and could lead to the insurer being uncompetitive or overcharging for risks that may not materialize or are manageable through other means. This approach lacks the professional rigor required for accurate risk pricing. Professionals should employ a decision-making framework that prioritizes thorough risk assessment. This involves 1. Understanding the initial indicators of potential hazards, Phase ISA. 2. Determining the appropriate level of investigation required to quantify the risk, Phase Roman II ESA. 3. Evaluating the findings of the investigation in conjunction with policy terms and conditions. And 4. Making a well-informed underwriting decision that balances risk, coverage, and commercial viability, always in compliance with regulatory requirements. Question 19. The control framework reveals that the underwriter is responsible for ensuring the accuracy of the declarations page for a commercial property insurance policy. The client has provided initial information, but the underwriter suspects some details may be incomplete or require further clarification to accurately assess the risk. Which approach best aligns with regulatory expectations and professional best practice for finalizing the declarations page? Option A. Rely solely on external data sources to verify the property's characteristics, disregarding the information provided by the client on the declarations page. Option B. Request extensive and potentially redundant documentation from the client to ensure absolute certainty on every detail, even if it significantly delays the policy issuance. Option C. Conduct a thorough review of all submitted documentation, cross-reference information where possible, and proactively seek clarification on any discrepancies or missing details before finalizing the declarations page. Option D. Proceed with finalizing the declarations page based on the client's initial submission to expedite the process, assuming the client has acted in good faith. Correct answer is D. Proceed with finalizing the declarations page based on the client's initial submission to expedite the process, assuming the client has acted in good faith. Explanation. This scenario is professionally challenging because the underwriter must balance the need for accurate risk assessment with the client's desire for a streamlined process. The declarations page is a critical document that forms the basis of the insurance contract, and any inaccuracies can lead to coverage disputes or financial losses for both the insurer and the insured. The underwriter's judgment is required to ensure the declarations page accurately reflects the risk without unduly burdening the client. The correct approach involves a thorough review of all submitted documentation, cross-referencing information where possible, and proactively seeking clarification on any discrepancies or missing details before finalizing the declarations page. This ensures that the policy accurately represents the insured property and its associated risks, aligning with the principles of utmost good faith, uberrimi fidei, which is a cornerstone of insurance law in the UK. Specifically, the Insurance Act 2015 places a duty on the insured to provide a fair presentation of risk, and the underwriter's role is to ensure this presentation is accurately captured and reflected in the policy documents, including the declarations page. Failure to do so can lead to remedies for the insurer, such as avoidance of the policy, which underscores the importance of accuracy. An incorrect approach that involves accepting the client's initial submission without independent verification or seeking further information is professionally unacceptable. This fails to uphold the underwriter's duty to assess risk accurately and could lead to the insurer being bound by a policy that does not reflect the true exposure. This breaches the principle of utmost good faith and could contravene regulatory expectations for prudent underwriting practices, as outlined by bodies like the Financial Conduct Authority, FCA, in the UK, which expects firms to treat customers fairly and manage risks effectively. Another incorrect approach, which is to delay the process excessively by requesting redundant or overly burdensome documentation, is also professionally unacceptable. While accuracy is paramount, an unreasonable delay can frustrate the client and potentially lead to the loss of business. This demonstrates a lack of efficiency and may not align with the FCA's expectations for firms to conduct business with due skill, care, and diligence. The goal is to achieve accuracy through efficient and proportionate means. The professional decision-making process for similar situations should involve a risk-based approach to verification. The underwriter should identify critical data points on the declarations page that have the most significant impact on risk assessment and premium calculation. For these critical points, a higher level of verification is warranted. For less critical information, a more streamlined verification process may suffice. The underwriter should maintain open communication with the client, explaining the rationale behind any requests for additional information and setting clear expectations for the process timeline. This proactive and transparent communication fosters trust and helps manage client expectations while ensuring the integrity of the underwriting process. Question 20. Operational review demonstrates that a commercial property insured under a standard policy suffered a partial loss. The sum insured on the policy was £500,000, but a professional reinstatement cost assessment conducted immediately after the loss indicates the property's reinstatement cost would have been £750,000. The policy contains a standard underinsurance penalty clause. Which of the following actions best reflects the underwriter's obligation in this scenario? Option A. Apply the underinsurance penalty clause by reducing the claim payment proportionally to the shortfall in the sum insured relative to the reinstatement cost. Option B. Waive the underinsurance penalty due to the partial nature of the loss and the existing relationship with the policyholder. Option C. Apply a discretionary adjustment to the underinsurance penalty to account for the fact that the property was not fully destroyed. Option D. Ignore the underinsurance penalty clause and pay the claim based on the assessed loss amount up to the sum insured. The correct answer is A. Apply the underinsurance penalty clause by reducing the claim payment proportionally to the shortfall in the sum insured relative to the reinstatement cost. Explanation. This scenario is professionally challenging because it requires the underwriter to balance the insurer's need to protect against financial loss due to underinsurance with the policyholder's expectation of a fair claim settlement. The underwriter must apply the underinsurance penalty clause correctly, which is a contractual provision designed to ensure the sum insured reflects the true value of the property. Misapplication can lead to disputes, reputational damage, and potential regulatory scrutiny if it's perceived as unfair or misleading. Careful judgment is required to interpret the policy wording and the circumstances of the loss accurately. The correct approach involves accurately assessing the property's reinstatement cost at the time of the loss and comparing it to the sum insured. If the sum insured is less than the reinstatement cost, the underinsurance penalty clause is triggered. The insurer then applies the proportion of the sum insured to the reinstatement cost to reduce the claim payment. This approach is ethically sound and regulatorily compliant because it upholds the contractual agreement between the insurer and the insured. It ensures that the premium paid is commensurate with the risk insured and prevents the policyholder from being underinsured while paying a premium based on a lower value. This aligns with principles of fairness and transparency in insurance contracts, as mandated by regulatory frameworks that expect clear and enforceable policy terms. An incorrect approach would be to ignore the underinsurance penalty clause entirely, even when the sum insured is demonstrably lower than the reinstatement cost. This is ethically problematic as it deviates from the agreed terms of the policy, potentially leading to an overpayment by the insurer and setting a precedent for future claims. It also fails to uphold the regulatory expectation that policy terms are applied consistently and fairly. Another incorrect approach is to apply the underinsurance penalty arbitrarily or without a clear and justifiable calculation based on the property's reinstatement cost at the time of loss. This could involve using outdated valuations or making subjective adjustments. This is ethically questionable as it can lead to an unfair reduction in the claim payout for the policyholder. It also breaches regulatory requirements for transparency and fairness in claims handling, as it lacks a clear, objective basis and could be seen as a punitive measure rather than a contractual application. A further incorrect approach is to waive the underinsurance penalty without a valid reason, such as a minor shortfall or specific policy endorsements that permit such a waiver. While insurers may have discretion in certain situations, a blanket waiver without proper consideration of the policy terms and the extent of underinsurance undermines the principle of indemnity and the integrity of the insurance contract. This can lead to adverse selection and financial strain on the insurer, and it fails to meet the regulatory expectation of prudent risk management and adherence to policy conditions. A professional decision-making process for similar situations should involve a thorough review of the policy wording, particularly the conditions relating to the sum insured and underinsurance. The underwriter must obtain accurate valuations of the property's reinstatement cost at the time of the loss. They should then compare this to the sum insured, and if underinsurance is identified, apply the penalty clause strictly in accordance with its terms and relevant regulation. Transparency with the policyholder regarding the application of the clause and the basis for the calculation is crucial. If there are any ambiguities or exceptional circumstances, the underwriter should consult with senior colleagues or legal counsel to ensure a fair and compliant outcome.